This is the last actual series of podcasts for the unit. And in this particular series, we're going to look at these different models of governance, or how contingency affects governance. In particular, we're going to spend a bit of time looking at different international systems of governance and how those factors in the international system affect internal governance in corporations and how those decisions are actually made. Thus, we're going to look at some different models of governance, look at how context or the situation facing a company affects governance in different types of organisations, and look at explore sources and explore some models of corporate governance, different ways of thinking about how governance works. Really, most governance differences can be boiled down to three key differences. One is the nature of the capital markets in a country. Okay? So the more liquid a capital market or illiquid a capital market in a country will affect governance there. Secondly, the legal system, and particularly things like shareholders' rights will affect the governance system that we have in place. And of course, third is culture, and particularly national culture. So we have these three elements of culture, the legal system, and capital markets that all affect the corporate governance system within a particular country. The next couple of slides just set out some relatively old data now, but I think still relevant data, that does governance actually make a difference in terms of the system and in terms of the companies that get invested from. So this comes from the McKinsey Global Investor Survey, and we can see that governance does affect the decisions. It affects avoiding certain companies and even avoiding certain countries based upon the governance regime that's in place. And this transfers through into various ratings of how important governance is within a particular system. So what you can see here is that the corporate governance relative to financial issues becomes less important in countries that have, say, more developed markets and more developed shareholder protections than in regions and countries that have less of that. So there's an interaction here between the importance of corporate governance in a company and the regime that it's in. The more robust from an investor perspective the regime, the less likely that governance will be something that becomes critical. In any respect, across all of these, what we see though is that there's a fair degree of equal or more importance in terms of how important governance is. So governance is important to the investment decision. Most investors actually report that they will pay a premium across the various regions of surprisingly similar amounts if there is good corporate governance in a company. The core aspect that I'd like us to think about in terms of international systems is the relationship between the external capital market and how decisions are made in the company. And I remember reading this Porter article years ago and thinking, geez, I've never seen anyone put it so succinctly. So I haven't never run across anything better to show this interaction between how the system that a company's in affects the internal decision making. So we've got a few slides on Porter's article here to try and explain the interaction going on. And in it, what he does is he kind of contrasts a typical Anglo system using the US with different systems, Germany and Japan, which tend to have more cooperative systems and communitarian systems. And it's really trying to draw this distinction. So individual companies can vary within these systems, but generally in the system we see these big differences, and that's what he looks to explore. So why don't we have a look at how he sees the interaction between the external governance of a regime or the system in a country and the internal governance of a company. Okay, so one of his starting points is to say, look, different countries have different patterns of share ownership. Things like, can we hold equity as well as debt, or are we precluded? So in Australia, a lot of banks aren't allowed to hold equity, for instance, whereas in Germany they can. So what we get are different patterns of shareholder ownership and therefore different kinds of agency relationships. These different patterns of shareholder ownership lead to different goals. In particular, In liquid markets of equity holders, you tend to get a far more focus on the short term or share price, right? Whereas in illiquid markets, or where you have cornerstone investors, you get far more long-term goals. And because companies can hold shares in each other, there's actually a bit of shared value in how they do things rather than competition. So we get sometimes the development of ecosystems in Japan, Keiretsus, chaebols in Korea, etc. So we get these different goals of the people who own shares. That, of course, means they monitor or emphasize and value things differently, right? Do we see training, for instance, as a long-term investment? Well, it can be, but if you're a short-term investor and you're not going to see the payback on that training, you might think it's a waste of money. So your particular goals influence how you value and what you see as important. And of course, that then influences management in different ways. Well, how does it influence it? Well, whatever we value and monitor is what are going to get set internally in a corporation as their goals, right? They're trying to meet the goals of their owners. And those goals then transfer into the internal systems, into the organization principles, and really importantly, our budgeting, and particularly our capital budgeting, right? So do we spend money on training this year, or do we give it to shareholders? Right? Or do we look at something like a short-term training or a long-term training initiative that's not going to pay off for a long time? How much are we going to invest in R&D? Right? All of these things have to be made at a capital allocation level and in our budgeting. They're driven by the corporate goals, which are influenced by the external capital markets. So what we can see is this pattern and shape of what's going on outside the organisation transfer through into the internal decision-making of a company. And what we have here is a deconstruction and a simplified version of the external capital markets in two areas, an Anglo or particularly a US-style system, right? So in the US-style system with very liquid markets, we tend to have transient owners, so traders buying and selling shares. They are then transaction-driven with fragmented stakes in the company. They rely on outside information, okay, what is disclosed, because they don't have a seat at the board table. And that drives their valuation and whether they choose to buy or sell. That means that the owners then have little influence directly on what's going on in the company. The only way we're making this influence in the company is through this buy-sell choice. And owners with little influence become transient. So we have this self-perpetuating system in place that reinforce this transient, short-term valuation, transaction-driven external market. In contrast, if we go to countries, say, like Germany or Japan, what we find is that often within companies, there's a large proportion that are permanent owners that are driven by relationships. And you've heard me mention before, Keiretsus are an example of that, where we hold long positions in the ownership of a company between companies that with significant stakes. That means those owners often sit on the board. So they have inside information in contrast to a market-based approach. So that means the outside valuation, or what the market sees, has far less effect on buy-sell choice. They're actually trying to influence the decision-making. And because they can influence it, it encourages more permanent ownership. It's actually the structure of this external capital market that becomes one of the key drivers for what's going on inside these organisations when they're making their capital allocation, their budgeting and their goal setting. Are they going to set short-term or long-term agendas? A lot of that gets driven by the pressure coming from the external market. And really that's what we get to see here. The typical US versus a German, Japan-style structure. What we have is limited owner influence, performance-based a compensation, limited information flow back to the owners, non-technical top management because they're more managing this relationship, etc. And we rely more on financial controls with capital budgeting that is quantitative. The marker then of success becomes ROI, or stock price. Contrast that with significant owner influence under the German-Japanese system, where we then tend to see more salaries, right? Why? Because there's more direct monitoring. And we'll know from agency theory that there are two ways to control agency costs. We either performance-based compensate or we direct monitor. Direct monitoring is possible under the German-Japanese system compared to the US system. So we see these differences occurring because of this extensive information flow back to the owners who are sitting on the board. It also tends to mean that we then tend to have top managers who are far more technical, who know what's going on in the business, and people measure and monitor to non-financial as well as financial controls. Okay, so the goal here is not ROI or stock price, but to keep the company going because we have this long-term ownership. So in the end, what we get are these reinforcing cycles within the capital market that influences the company that leads to an overall system. So in something like a US-based system, you tend to find that they do less overall investment because the companies are far more sensitive to current returns, to making money in the short term because of these pressures. And it favours those forms of investment which are measurable, things like mergers and acquisitions, right? And an underinvestment on things that are harder to measure, intangible assets such as training or R&D. So therefore you can underinvest in those and overinvest in things like mergers and acquisitions. Notice in contrast, in the Japanese-German system where we have this dedicated capital with a secure corporate position, we get exactly the opposite problem, right? You tend to get overinvestment in things like training and R&D. Yes, we invest for the long term, but there can be a problem. Also, we get far less responsiveness to changes in demand. You know, there's a long-term plan, whereas the US system is much more fluid and able to react to changes in demand and new opportunities as they arise. So Porter's view is not that one system is better than the other. It's actually really saying that there are parts of both systems which would be really useful to have. And so he has a number of policy prescriptions, allowing people to hold both debt and equity to allow for this longer term position in the US system, to allow for grey directors, those interested directors, to get this flow of information from associated companies to change the pattern of decision making, as well as several others that are really looking to expand the influence of these associated entities. So I'll leave you to look at those recommendations in detail, but it's all about getting a longer term focus in the decision making in the US system and making sure we don't overinvest and can respond to opportunities under, say, a German, Japanese or a dedicated capital system. In the next one, we're going to look at some different board structures that can flow from some of these different capital markets.